Hi, morning everyone. This is Tara. In this week's webinar, we'll be sharing our outlook for the Singapore property and REIT sectors, updates on CapitaLand Commercial Trust, First REIT, and our weekly musings for China and Singapore, as well as our China strategy. So we'll start off with the outlook for Singapore property sector. Can see on the left, it's the private residential prices all the way back to 1976. So the last price increase was started in end 2017 all the way up to last year, July 2018. That's when the July 6 property measures came in. So since then, transactions have collapsed about 30% year on year, year to date, and this compares to the almost 30% increase the same period year on year the year ago. So this interesting to note is that this close to 9% increase in just a mere 5 quarters is a definite consideration for the cooling measures to come into place, as typically it would have taken about 9 consecutive increases in prices for any form of cooling measures to come into place. And in contrast, it took about 16 whole quarters for prices to moderate down by about 12% from the last peak in mid-2013. For demand, we expect demand to be muted in the near term, as essentially the property measures would affect second-time buyers and investors. So right now, the pool of buyers is largely first-home buyers and en-bloc sellers. On the supply side of things, this year we'll be seeing close to 60 launches. That's about 18,000 units, and this is well in excess of the average annual demand of about 9,000 units. On top of that, the URA had announced the government land sales tenders for the first half of this year, and it's actually the lowest level since first half of 2007. So it's the lowest level in 12 years. And from there, we see a possibility of a halt in confirmed GLS sites, as we have witnessed in 2009. And back then, the reason was to adjust for the supply, and this could possibly be the situation that would happen as well going forward. And that could provide a temporary relief for the developers, especially as the collective sales market has also cooled, as we see reserve prices being cut in excess of 20% for sites such as Parkview mentioned. So we expect a mismatch in demand and supply, and for some developers to definitely have to swallow thinner margins going forward. And some of these developers would also have to be jostling among themselves to try to roll out their launches early to adopt a first come first serve or to gain a first mover advantage, especially in locations with multiple developments. So just this weekend, we have seen in the news that All Green Properties, which launched the 4th Avenue residence, has seen a take-up rate of about 30%. So that's still quite healthy, but it remains to be seen if this take-up rate will continue on for the other developments as well. And within that same vicinity, within the same district, Oxley will also be releasing their Mayfair Modern, so that would set the base for the sensitive pricing among the developers. And on the left, there's the chart for the uncompleted primary launches and the respective take-up rate. So as the title suggests, the re-rating catalyst for the Singapore property sector would be sustained sell-through rates. And our expectations for the private residential prices is flat this year, about -1%. So this is still relatively stable by virtue of the higher land prices that had progressively already been locked in. So we downgrade our view from positive to neutral for the Singapore property sector. So moving on to REITs. On the left, you can see the dark blue line below, that's the yield spread. It's still very close to the -1 SD line post the global financial crisis. And the rising interest rates will still continue to be a headwind, but on the yield side of things, there's a slight relief, as this year we're only expecting 2 interest rate hikes compared to the previous, the 3 rate hikes that were previously predicted earlier last year. And on the finance side of things, the 3-month SOR had risen quite a bit last year. It started the year about 0.88%. And it ended last year, December, at 1.91%. So that's almost a doubling in the SOR. And unless the REITs can grow their rents faster than the rise of their interest costs, there could be pressure to increase their DPU. So for the REITs, we are expecting a growth of about -1 to 5.3% across all subsectors. And for the interest costs, this is something we're always keeping tabs on, as this is typically the single biggest component for all the REITs, about 20% of their net property income. Just to go through quickly for the 4 subsectors. For retail, we are neutral, as we see very high supply still coming in, above the 5-year historical net annual demand. And occupancy costs, which is measured by the rents over the total tenant sales for the tenant side of things, it's still on the rise, and this is not helped by the falling tenant sales and declining footfall that we've seen reported by all the retail REITs. For commercial, the current upward trajectory in the prime grade A rents is continued to sustain, especially with the tapering supply situation and the high demand and leasing inquiries coming in. So once this surpasses the expiring rents, positive and higher reversions are expected to be clocked in. For industrial, there's also a tapering supply situation. However, there's a tepid industrial activity, as evidenced in the recent manufacturing and PMI data. So that's weighing down the demand. And the consolidation theme among the smaller REITs are still in play, as we have witnessed the merger between ESR and Viva last year. And we have noted that Yishang Redwood, ESR, also has stakes in AIMS-M and Sabana REIT. For hospitality, we have an accumulate rating on, as there's also the positive situation of tapering supply. And a possible catalyst for this subsector includes the potential attainment of hotel license for the service residences. So this could potentially increase RevPAR in the long term. And overall for the REIT sector, we have a neutral with preferences on the commercial and hospitality subsectors. So moving on to CapitaLand. So for these 2 stocks that I'll be presenting next, CapitaLand and CapitaLand Commercial Trust, these 2 are in our absolute 10 portfolio. So CapitaLand, the main investment thesis for us is their recurring income portfolio, which now accounts for more than 80% of their earnings. This is about 88% of their EBIT as of the latest 9 months results. And over the past 3 years, they've doubled their investment properties. And if you take a look on the left, the graph shows that they've been steadily increasing their total AUM over the years. And on the recurrent income portfolio, their strong suit is in retail, of which we have seen double-digit tenant sales growth for their China retail portfolio, which is their biggest, which is where their retail portfolio is biggest in. And moving on to the development side of things, the management had communicated that for Q18, the results of which would be out in about 3 weeks' time, will be a bumper quarter for China residential pre-sales. And in 4Q18 alone, all their launches have actually clocked in more than 90% take-up rate for all of it. And this healthy momentum is expected to persist for the other 1,000+ units they are expected to be launched. On the capital recycling end, they've been acquiring prime residential sites in the key regions of Guangzhou and Chongqing. And as you have seen in the news, they've also divested their 70% stake in Westgate to CapitaLand Commercial Trust. So these are some of the areas where they're redeploying capital at. Another reason why we like this counter is because of its limited Singapore residential exposure. So right now they only have Pearl Bank and their 50-50 JV with CDL for the Sengkang Central Mixed Use site. We maintain and accumulate with a target price of $4 for this counter. And you have seen in the news last week, the major news was that CapitaLand had announced a proposed acquisition of Ascendas Singbridge. So essentially, this would be a merger of these two entities. And we see this transaction as a positive, as it would increase CapitaLand's exposure to the industrial and logistics assets, both which they do not currently have presence in. So these will add these two new business verticals to CapitaLand and also increase their presence in emerging markets such as India, which it previously did not have an investment management platform in. If you took a look on the left, it's quite a useful infographic that's pulled out by the company presentation. So the green dots represent where Ascendas would be coming on in. And something that we've noted is that though this transaction is immediately accretive to EPS and ROE, it's slightly dilutive to NAV, about a 4% dilution. However, the management had communicated that they would boost the NAV through the combined fund management platform as well as the development pipeline. So overall, we are positive on this transaction, which is expected to be finalized by the third quarter, as we see CapitaLand developing critical mass, adding new business verticals and generating more resilient and more recurrent earnings, especially as Ascendas would be directly contributing a set of operating assets that would hit the ground running for CapitaLand. And another thing to note is that the next step for them following this transaction would be the deleveraging of about $3 billion to reduce their leverage by the end of next year. So we can see more asset recycling going forward within this time period. So moving on to CapitaLand Commercial Trust. So for this counter, we see it as an almost pure play proxy to the Singapore prime grade A market. And this would allude back to my point earlier on the office REITs, that the current upward trajectory in rents is expected to be continued, helped by the favorable demand-supply conditions. If you take a look on the left, you can see the uptick in occupancy and rental index. And another thing for CCT is they made their very first overseas acquisition last year. And this could possibly pave the way for their expansion of overseas pipeline. So from there, we can see potentially higher yields and for them to diversify their current rental income portfolio. There's also possible upside potential from their Capital Spring redevelopment project. So this was the former Golden Shoe car park. They have a 45% stake in this project together with CapitaLand and Mitsubishi. And this is expected to be launched in first half of 2021. And ahead of this launch, they've already secured JP Morgan as a key anchor tenant. On top of that, they also have a call option to acquire the remaining 55% of the commercial component. And their debt has been pared down significantly last year. Now debt on fixed rate comprises about 92% of total borrowings, with a lower all-in cost of debt at 2.6%. So we maintain and accumulate with a target price of $1.90. So this gives a dividend yield of about 5%. Moving on to First REIT. We released an update report last week. This was mostly on the back of an earlier briefing that the manager held in December last year to provide updates on the REIT's new co-sponsor, OU Lipo Healthcare, their receivables collection, and their portfolio rebalancing strategy. So we were informed that they would align and identify more strongly with their co-sponsor, OU Lipo Healthcare, especially since Lipo Karawaci had went out to announce their intention to divest its remaining stake in First REIT. And just to give a refresher for those who are not have not been following this counter, the main issue for this REIT would be that more than 80% of their rents are currently reliant on Lippo Karawaci, which is also the co-sponsor. And Lippo Karawaci had been running into some cash flow and liquidity issues and had been issued multiple credit rating downgrades within last year alone. And that the impact for First REIT is that their receivables from them had been slower than usual. So the key risks that we've pointed out in our past few reports would be the receivables collection, and the lease renewals that are upcoming in 2021 could be affected as well. So the negative that we've seen that in this briefing would be that most of the lease renewals are likely to be renegotiated with a lower quantum if the leases were to be transferred to Siloam Hospitals, which is the current operator, and or on Indonesia rupiah denominated terms, as it's currently in SGD terms. And the manager had communicated that the next acquisition, which will be likely to be from OU Lippo Healthcare side, is more likely to be a portfolio rather than piecemeal. So from there, we foresee that their current 34%, close to 34.9% gearing inhibits any accretive acquisitions. With a 2080 capital structure, a call for fresh equity capital is likely. So could see equity fundraising more likely in the near horizon. And that would be dilutive for NAV and DPO side of things. NAV will drop from 1.01 to 0.98 if this were to happen. And this would not be helped by the manager's base fee structure, as it's a fixed percentage of the NPI, regardless if it's a yield accretive asset or not. And even acquiring yield accretively in a development market as opposed to Indonesia will be a challenge for First REIT. So overall, we maintain neutral with a lower target price of 88 cents, previously was $1.50, as we lowered our revenue assumptions on the back of the likely situation of lower quantum of leases with the renewals coming up and the risk of the equity fundraising. And we have also raised our discount rate to factor in the credit risk associated with their current co-sponsor and major tenant, Lippo Karawaci. So that was the update report that we released before the results. And this morning we have just released our results report. So the positive for coming out of this, their full year results was that they've actually had the contribution from the two properties that acquired in FY17. So we've seen revenue and NPI gone up. And also their cost of debt is still relatively stable, as the manager had communicated that even with the rising 3-month SOR, their margins from the banks have been declining. However, the same risks as we pointed out in the past reports remain. So receivables still continue to mount, and receivables days are about 100 days compared to the previous 89 days, against the backdrop of the uncertainty over the upcoming lease expiries, as I've mentioned in the previous update report. And also they've reported a decline in their portfolio valuation. On a like-for-like basis, last year, excluding the acquisitions, their like-for-like portfolio had increased about 1.7% compared to the decline this year. And outlook-wise, we see some ray of light from the new co-sponsor, OU Lippo Healthcare, with their expanded referral pipeline. So right now they have 2 referral pipelines from both Lippo Karawaci as well as OU Lippo Healthcare. So there are 2 streams that they can draw down properties on. However, we remain cautious on the acquisitions going forward, as conducting these yield accretive acquisitions will be a challenge, and the overall outlook is not helped by the mounting outstanding receivables and the rising uncertainty over the Indonesia leases that are up for renewal. With that, I'll move on to Mike to talk about China.
Thank you, Tara. For China last week, there is two main economic indicators released last week. One is China bank loans on December 2018, which is also the big expectation. This is the follows our China strategies. We believe the Chinese government will invest more to support real economic in 2019. Also, the 70 cities housing average price also is increasing, beat the expectations. For the stock recommendations, our Hong Kong research teams recommend Weicai, CSPCs, and Monios. This is a list of the stock recommendations our Hong Kong research teams recommend. We added the Weicai, CSPC, and the Monio. I will give the brief introductions about my report last week. The China strategies. The main ideas is to follow the policies. In these years, we are recommended the property sectors and the new energy vehicle sectors. For the consumer sectors, we believe that China's government will invest more and offers the more policy supports to the consumer sectors. We especially focus on those industries have the policy spots like the automobiles consumptions, green consumptions, and technological industries, of which we recommended the new energy vehicles, especially based on the total amount and the growth rate. Here we can see the growth rate of the new energy car sales are much higher than the total car sales. We believe on 2019, under the stimulations of the continuing subsidies and double points policies, new energy vehicles will perform well in this year. Also, because the China government released easing signals of the real estate, we believe that in 2019 the local governments will. We already see a local government already do these reasons to boost the property sectors. One is lowering the first housing mortgage interest rate. Secondly, they lower down the payment ratio, down payment ratios for buying a house. Third, they lower the bars of the buying the local property and the settlements. Also, we are observed that the valuations of the property sectors are in the historical relatively low now. In 2019, we are overweight on property sectors. This is a four ETFs that we recommended: the KARS, DRIV, TAO, and the CHAR. I will move to the part for Philip's Singapore weekly musing.
Okay, thanks, Mike. Okay, I'll move on to just our Singapore week, just a weekly update, week 4. In terms of the for week 4, in terms of the macro or economic for last week, we got the big number from Singapore was the exports declined to their 26-month low. It actually fell 9% year on year. And the decline was actually not only on electronics, but in petrol, was in chemicals and also pharmacies. So actually the problem was the decline was across all segments. The other big macro news from the US was because of the shutdown, there won't be much data, but the big one that came out was of the US consumer confidence number. The reading was the lowest in 27 months at 90.7. I think obviously the focus now in the US in terms of economics is the shutdown. The shutdown has run to the longest on record. I think for investors, the key would be two things. Firstly, from the rating agencies, they are looking at the impact that this shutdown has as the negotiations for the debt ceiling comes about. As you know, in 2011, there was a downgrade in the US credit due to because they could not settle on raising the debt ceiling. It will start on the 2nd of March. And the other thing about the shutdown is that it's hard to factor in a major to model in a very major impact on the US economy, because the reversal can be fast. More important is whether this shutdown will cause some permanent damage to the US economy. I think that will probably translate through confidence or sentiment, through whether businesses will will be on consumer confidence and also on business sentiment. I don't think that confidence reading was due to the shutdown, but this is the what is more worrying is the impact on sentiment. One final part is that there was some rumor on the US trade negotiations. The rumor is that China will buy more than 1 trillion of goods till 2024. I think 2024 is exactly just nice because it's the end of Trump's. If Trump gets elected in 2020, then of course it will end at 2024. So I wouldn't call this a buyout, but actually this makes it very timely for China to make the 1 trillion worth of purchases. The other round of negotiations will be in January. In terms of corporate news, I think most of the corporate news revolves around property sector, which Tara updated. But I guess the only interesting tidbit for us is we don't cover high flux and so forth, but there's been a lot of news on just corporates having some issues with their debt. I think the one that came out was a high flux. I think for those who did not know, they just made an announcement that if there's a liquidation of the company, the perpetuals and the preference shares will get zero recovery. That means basically you won't get anything. And for those, the secure, unsecured, senior unsecured, such as banks and note holders would get maybe 4 cents, 4% or 3.8% or 4 cents or to 9 cents for every dollar of their loans. There was also this, then there were more e-corporates in announcing debt problems, which is like Falcon Energy and because they suspended their coupon, and also Sinogranus, where one of the shareholders actually sued them to repay US 21 million that they owed. In terms of tactical, we are still, like we mentioned for a few weeks, we are still positive on market in the near term. I think we should take on more risks, be it electronics and so forth, even some stocks that we don't cover like venture and so forth. I think what we think is that in terms of the sequence of events, I think firstly, we think there'll be a positive trade negotiations, and the other positive is there'll be as you all know, the Fed will probably eventually say that they're going to pause on rates, and also this will actually help. You can started to see the yield curve started to steepen. So all these are positive news, and the next in sequence will be we will eventually see better economic data. So all this could actually play out in the next few months, which will be helpful for the market. And the other thing to note, at least thematically, is that most of the policy risk now, as you recall, in 2018, there was a lot of policy risk coming out from the dispute between US, China, and also a higher interest rate. So all this affects the Asia. But this time around, the policy risk, government policy risk, it seems to be more confined to the US. As you can see, all the political, the turmoil that's happening now in the US. So in a relative sense, this will be a positive for the region, and also helps some of the flows back into the region. Okay, that's it for me. The bottom is just some of the key events for weeks ahead. The next slide, sorry, it's a bit small if you print it, but anyway, this is just a list of all the Singapore companies that's releasing this is the date of the release of the results. This is the quarter results, and this is the consensus EPS. This is not our EPS, this is the consensus estimates that comes up from Bloomberg. For those who want to know when the dates that's coming out, all these are, we got it off from Bloomberg. So most of the banks will actually release the results around here, the 22nd and so forth. Okay, thanks. Is there any questions? Hold on, please. We're just looking through the questions. Thank you. Okay, there's one question pertaining to NBN NetLink Trust. How would the rollout of 5G in the future affect the performance and hence the DPU? I think you can say that the 5G is like some free upside option for them, because once you have 5G, then you will need more bandwidth, so they will need the fiber. There will be more fiber used, and also they will have to deploy a lot of those small little what do you call it, micro. micro antennas, or I've forgotten the exact term, but a lot more microwave radios. So because of that, there'll be more connection and connectivity. So all these will benefit NetLink Trust. Because once you hit 5G, you have to put a lot more antennas and all these small base stations around. So this will be beneficial for NetLink Trust. Okay, there's a question where to find the earnings release date and their consensus. What you see on the table here, all this we just downloaded from Bloomberg. So everything comes from Bloomberg. So some of the dates which are not final, then maybe the Bloomberg will just give an estimate. But if you want the exact, most of it is correct, but if you want the exact, you got to look at the SGX announcement. So you got to sort out you go to the SGX website, then you just sort it out by financial results, then all the release dates will come out. But the one that you see on the chart here, it all comes from Bloomberg. Okay, sorry, can you repeat about the previous mentioned 5G? Oh, yeah, sure. So sorry if I speak a bit fast, but okay. Anyway, basically, as you know, NetLink Trust, the business model, very simplistically, they're just renting, they're just collecting rent on their fiber network, and when Singtel parks some of their equipment into some of their premises. So that's the rough basic model of a NetLink Trust. So when you have a 5G, then they will have to deploy more microwave radios. Because of 5G, because of the bandwidth, you cannot have so few, like 4G only has and just very layman terms, just maybe in 1 square meter, maybe got 3 to 4 microwave radios. I'm exaggerating it. But once you hit 5G, you probably need to deploy multiple times that. So when you have so many things, then they would, then after that, so as a result, NetLink Trust will the more sources of revenue for NetLink Trust, because they will provide the connectivity, not into the fiber but all these microwave radios will connect to their network. So this will benefit NetLink Trust. Sorry, just give us a second. We got a few questions on REITs. Yeah, give us a second. Yeah, someone said, can you put the slide on China stocks and target price? Yeah, okay. These are the ETFs. Yeah. Someone asked for the ETFs. I knew the ETFs is in his report. I think he sent out a report on the ETFs. Yeah. Just for this thing. Yeah.
Hi, this is Tara. So there's a question on where to find market rental and interest costs. For market rental, you can actually go to URA's website directly. They have very specific market rental for all the different by street names. So it's very specific for retail and office. Can get down to the dollar or rather the cent for the different street names. And for interest costs, we at the back of our report, the latest would probably be a little dated, but that would be based on the latest quarters, most of it third quarter, since most of the REITs have not released their results yet. So from there, you can see all the all-in costs that we have listed for all the REITs. And there's a question on First REIT. If Parkway Life REIT can perform well with Japan nursing homes, why would First REIT not be able to do so if such properties are injected into First REIT? So the nursing home yields are about 5+% for Parkway Life REIT. I think it's around the same as well. So the issue is that First REIT has a lot. Their all-in interest cost is a lot higher than Parkway Life REIT. Then again, Parkway Life REIT's debt is in Japan yen, but as we have clarified with the manager, they might not have the same ability to get the same rate as Parkway Life REIT, especially since they have a first mover advantage and the credit standings for both are different. So if net, the net yield might not be the same as what Parkway Life REIT is getting. So that was why we pointed out that acquiring yield accretively in a development market such as Japan might be a challenge for First REIT given their current situation and their credit standing.